Okay, let's unpack this. Ever feel like the way legendary investors like Warren Buffett picked stocks back in the day is just a million miles away from today's world? With all the complex financial
Yeah,
models.
it can seem like totally different
It's
worlds.
almost like they were operating with some kind of secret code. Well, today, we're going to try and decipher a key part of that code for you.
How so?
Looking at how that classic approach, that security analysis, actually fits into, well, modern financial thinking.
Ah, right. And what's fascinating here is a recent academic paper that really digs into this exact connection.
Okay.
It's called The Economics of Security Analysis, and it puts forward this pretty compelling idea
Which is,
that the investment capital asset pricing model, the investment CAPM, let's call it, can actually explain the economic logic behind the methods of giants like Benjamin Graham and David Dodd.
wow, even in markets that we think are pretty efficient.
Even within efficient markets, yeah, that's the argument.
Exactly. So our mission today is really to get under the hood here.
Yeah.
We want to understand how these two seemingly different schools of thought, the traditional wisdom and contemporary theory, how they really align.
Makes sense.
We want to pinpoint the fundamental drivers of investment returns by looking straight at the findings of this research. We're going to explore specific investment strategies
Uh-huh. Yeah.
and even see how some of the top-performing investment fund managers fare when you look at them through this particular lens.
And the foundation for our deep dive is this really rigorous research paper, The Economics of Security Analysis,
Right.
by Kewei Ho, Haitao Mo, Chen Xu, and Lu Zhang, published in Management Science just recently, 2024.
Okay.
And it meticulously examines a whole range of established security analysis techniques and how they relate to something called the Q5 model.
Q5.
Yeah, which is essentially a practical way of applying the principles of that investment CAPM to real world data.
All right, so to start cracking this code, let's go back to the originators, right? The godfathers of security analysis, Graham and Dodd. What was the core idea behind their approach?
Well, at its heart, their philosophy was really all about finding and buying securities that they believed were undervalued.
Okay.
So stocks trading on the market for less than their intrinsic or, their true worth.
Like finding a valuable antique at a garage sale, that kind of thing.
That's a great analogy. Yeah, exactly like that.
And their thinking wasn't just some, fringe idea, was it?
Mm-hmm.
They had a massive influence on some really big names in investing.
Oh, absolutely. Their work really laid the groundwork for investment titans like Warren Buffett, Joel Greenblatt, Seth Klarman, Bill Miller, even Charlie Munger. I mean, these are individuals whose investment philosophies and track records pretty much speak for themselves.
But this idea, this ability to consistently find undervalued stocks, it always felt a bit, I don't know, at odds with the modern view of efficient markets. What's the core tension there?
Yeah, that's really the central puzzle, isn't it? The efficient markets theory, especially in its strong form, basically suggests that current stock prices already reflect all available information.
Right, so no bargains to be found.
If that's true, yeah, it should be virtually impossible to consistently identify undervalued stocks and get returns that are better than the market average, over the long haul.
Mm-hmm.
Security analysis, though, is built on the exact opposite premise, that these discrepancies between price and value do exist.
And smart investors can find them.
And that smart, diligent investors can actually take advantage of them.
So how exactly did Graham and Dodd define this intrinsic value they were always talking about? It wasn't just a gut feeling, right?
Right, at all. No, they were very clear that intrinsic value should be grounded in tangible facts, things you could actually analyze.
Like what?
Like a company's assets, its profits, earnings, the dividends it pays out to shareholders, and its realistic prospects for the future, definite prospects.
Okay.
They specifically distinguish this from the daily ups and downs of market prices.
Right, the noise.
Yeah, which they saw as potentially swayed by, irrational emotions or speculative trends.
So it wasn't about calculating one precise, perfect number down to the penny, but more about establishing a reasonable range
Precisely.
to see if a stock was significantly cheaper than it maybe should be.
Exactly. Their goal wasn't to pinpoint an exact figure. It was more to determine if a security was priced fairly or, more importantly, if it offered a substantial margin of safety.
Ah, the margin of safety.
It's true.
Crucial concept.
Absolutely crucial. Trading well below their estimated intrinsic value. That margin was key to protect against errors in their own emphasis or, just bad luck, unexpected negative stuff happening.
And that brings to mind that brilliant Mr. Market analogy. Can you just remind us how that story helps illustrate their perspective? It's such a good one.
It really is. Graham, in his classic book, The Intelligent Investor, he personified the stock market as this somewhat erratic business partner named Mr. Market. And every day, Mr. Market shows up at your door offering to either buy your shares or sell you more, all at his quoted price for the day.
Right.
Sometimes his prices seem to make sense, based on how the underlying business is actually doing. But often he's driven by wild optimism or deep pessimism,
So his prices are all over the place.
leading to prices that Graham famously described as a little short of silly.
Uh,
But the key insight is you don't have to trade with Mr. Market every day.
you can just ignore him some days.
Exactly. You can stand back, observe his sometimes irrational behavior, and only act when he offers you a particularly attractive price, either to buy from him cheap or sell to him high.
Okay, so we've got a good handle on the core tenets of Graham and Dodd's security analysis. Now, here's the million-dollar question, I guess. How does this seemingly old-school approach fit with the more modern ways of thinking about finance?
Right.
Where does this investment CAPM come into the picture?
Okay, here's where it gets really interesting. The investment CAPM provides a different lens, a different way to view how securities get priced.
How so?
Instead of primarily focusing on the demand side, what investors are willing to pay, it shifts the focus over to the supply side.
The company's issuing the stock.
Exactly, looking at the decisions of the companies themselves.
So it's about what motivates a company to, invest in its own business, build a new factory, do R&D, that sort of thing.
Precisely. The investment CAPM essentially posits that a company's expected return on its investments.
Which is what investors demand for holding the stock, right?
Right. That expected return or discount rate is related to the potential benefits of those investments relative to their costs.
Okay, benefits versus costs. What are the benefits and costs here?
The benefits are things like expected future profitability and growth, the good stuff investors hope for.
Makes sense?
And the cost is linked to something called Tobin's Q.
Tobin's Q. Okay, that's a new one for me. Can you break that down just a bit?
Sure. Think of Tobin's Q roughly as a ratio. It compares a company's market value, what the stock market thinks it's worth, to the replacement cost of its assets, like what it would cost to rebuild the company from scratch today.
Okay, so market value over replacement cost, what does a high or low ratio tell us?
Well, a high Tobin's Q, say above 1, might suggest the market values the company's future prospects and maybe its intangible assets like brand or patents very highly compared to its physical stuff. That might signal the company has good investment opportunities and maybe should invest more. A low Q, below 1, might indicate the market sees less growth potential relative to the tangible assets already in place. Maybe investing more isn't such a great idea for that company right now.
Okay, that makes a bit more sense. So how does this company-focused perspective, this Tobin's Q thing, connect back to the Graham and Dodd idea of buying high-quality stocks at bargain prices?
Well, here's the connection. The investment CAPM suggests that to achieve higher expected returns, investors should look for companies that exhibit high-quality characteristics.
Like strong potential profits and growth.
Exactly, those benefits we mentioned. High expected profitability, high expected growth. But they should be trading at bargain prices.
And bargain price means?
In this context, it means having a relatively low Tobin's Q, low cost relative to the quality. And this prescription by high quality at a low price, or low Tobin's Q, is remarkably similar to the fundamental advice Graham and Dodd were giving decades ago.
Wow. Buy good companies when they're cheap.
It's like they arrived at the same destination, the same investment philosophy, but from completely different starting points, different maps.
It's like they were both looking at the same elephant, maybe from different sides of the room, and describing it in their own language.
That's fascinating.
It really is.
And you mentioned there's an empirical way to test these ideas, the Q5 model. How does that help us see if these security analysis strategies actually work in practice according to this framework? Right, the Q5 model. It was developed by the authors of this paper and some other researchers. It basically takes the core logic of the investment CAPM and translates it into 5 specific measurable factors. These factors help explain why some stocks generate higher or lower returns than others. On average, they are market risk, company size, the company's investment level.
Okay.
Its profitability, which they typically measure as return on equity, or ROE.
Got it.
And its expected future growth. So market size, investment, ROE, and expected growth.
Q5.
Q5.
Yep.
And by analyzing these 5 factors in relation to various classic investment strategies, we can see if the investment CAPM provides a fundamental economic explanation for why those strategies might have worked.
Fantastic. So let's get into some of those specific quantitative security analysis strategies that the paper takes a look at. First up is the work of A. Barbanel and Bushy from 1998, focusing on fundamental signals. What did they find, and how does the Q5 model help us understand it?
Right, A. Barbanel and Bushy. They identified a set of 7 fundamental signals, things like changes in inventory, accounts receivable, capital spending, gross margin changes.
Stuff from the financial statements.
Exactly. Things that might indicate how well the business is actually running. They found these signals could predict future earnings surprises and, consequently, stock returns.
Okay.
Now, the paper's analysis shows that the Q5 model largely accounts for the excess returns generated by combining these signals.
It explains them away, basically.
To a large extent, yes. And interestingly, the return on equity factor, the ROE factor within Q5, appears to be a key driver.
Why ROE?
Well, essentially, companies showing these positive fundamental signals tend to be more profitable. And the investment CAPM tells us higher profitability, higher ROE, should lead to higher expected returns. It makes economic sense.
That makes intuitive sense.
Okay.
Yeah. A company that's managing its operations efficiently, generating strong profits, is likely a better investment. Okay. What about Frankel and Lee's research? They looked at the ratio of intrinsic value to market price, right? How does the investment CAPM interpret that?
Yeah, Frankel and Lee used a specific model, a residual income model, to estimate a company's intrinsic value.
Okay.
And they found that the ratio of this estimated value to the actual market price could predict future returns. High intrinsic to market meant higher future returns.
There's like a value measure.
Exactly. And the paper demonstrates that the investment factor in the Q5 model plays a really significant role in explaining why this intrinsic to market ratio has predictive power.
How does the investment factor connect there?
Well, according to the investment CAPM, companies with high market valuations relative to their assets think high Tobin's Q again are expected to invest more. And higher investment generally leads to lower expected future returns, according to the model. Conversely, companies with lower valuations, lower Tobin's Q, tend to invest less and have higher expected returns.
Oh, okay.
So even if the market isn't necessarily wrong or inefficient, differences between an estimated intrinsic value and the market price can arise just from errors in forecasting future cash flows, or maybe using the wrong discount rate in the valuation model. And it turns out these differences often align pretty well with the investment factor. Low estimated value relative to market often goes with high investment and vice versa.
So again, it's not always about spotting some clear market mistake, but maybe more about understanding how these fundamental value indicators relate to expected returns through the lens of the company's investment decisions.
Precisely. And think about it. The book-to-market ratio, which is a key component in many intrinsic value estimations like the one Frankel and Lee use.
Yeah, a classic value measure.
It's inherently linked to this investment factor within the investment CAPM framework. Companies with high book-to-market, low market values relative to book are often those that have invested less aggressively in the past.
Got it. Okay, next up is a strategy that's become quite well known, Greenblatt's magic formula. Buying good, cheap companies. How does that hold up under the scrutiny of the Q5 model?
Right. Greenblatt's magic formula, it famously involves investing in companies that score highly on 2 things. Return on capital, which is a measure of profitability, like ROE.
Quality.
And earnings yield, which is like the inverse of the PE ratio, a value metric.
Cheapness. So quality and cheapness.
Exactly. And the paper's analysis indicates that the Q5 model does a pretty good job of explaining the returns generated by this formula.
Which factors drive it?
The return on equity, the ROE factor, is again a significant contributor, which makes sense, right? High return on capital is basically high ROE. This just reinforces the idea that more profitable companies should offer higher expected returns. The investment factor also plays a role, particularly for the smaller companies identified by the formula.
Why the investment factor too?
Because that high earnings yield part, the cheapness metric, is often a proxy for being undervalued relative to assets, which, as we just discussed, links back to lower investment and thus higher expected returns in the model.
Okay, it's all starting to connect.
Yeah.
Moving on to the quality minus junk factor. This was developed by Cliff Asness and his colleagues at AQR, right?
That's right.
They define quality based on profitability, growth, and financial safety.
Yeah.
How does the Q5 model account for the premium we see with these high-quality stocks?
Yeah, Asmus and his team found that stocks exhibiting these high-quality characteristics tend to outperform those considered junk, a quality premium.
Right.
And the Q5 model, again, largely explains this quality premium. It seems both the Rho factor capturing that profitability aspect and the expected growth factor are quite influential here.
So profitability and growth are key to quality.
According to this framework, yes. High-quality companies, as defined by Asmus et al., tend to have maybe lower market risk and invest less aggressively, but their higher profitability and better growth prospects, which are captured by the Rho and expected growth factors in the Q5 model, appear to be the dominant drivers of their higher returns.
Interesting.
They also noted in the paper that when they refined the quality measure slightly, specifically adding shareholder payout as a component.
Like dividends and buybacks.
Exactly. The results aligned even more closely with the predictions of the Q5 model in some of their tests.
It's fascinating how these different facets of what we intuitively think of as quality seem to map onto these specific factors in the Q5 model: profitability, growth, maybe investment levels too.
It does provide a more structured way to think about it.
Okay, what about Bartram and Greenblatt's agnostic analysis? That sounds intriguing. It looks at how a company's market value deviates from an intrinsic value implied by its peers.
Yeah, it's a clever approach. Bartram and Greenblatt used a statistical method. They looked at a broad range of accounting variables across similar companies in the same industry
Okay.
to basically estimate what a normal or implied intrinsic value should be for a given stock based on its peers' characteristics.
Right, like what the price should be if it were just like its neighbors.
Kind of, yeah. And then they found that the difference between this peer implied value and the actual market price could predict future returns. If the market price was way below the implied value, returns tended to be higher.
Another value signal.
And the Q5 model.
The paper's analysis suggests that the investment factor is really key, again, to understanding the success of this strategy.
Investment again.
It seems to reinforce the idea that when a company's market valuation is low, relative to what its peers' characteristics would suggest, it's often linked to lower past or expected future investment, which, as we keep seeing, the investment CAPM associates with higher expected returns. It's quite consistent, isn't it? Okay, and then there's the ratio of operating cash flow to market value. The paper highlights this as a particularly robust indicator of value, maybe even better than the traditional book-to-market ratio.
Yes, they found operating cash flow to market is indeed a strong predictor of future returns, often outperforming book to market in their tests.
And how does the Q5 model interpret its predictive power? Does it explain it?
It does, significantly. When they analyze this cash flow to market strategy through the lens of the Q5 model, they find the model substantially reduces the abnormal returns, or alpha, especially for larger companies.
And the driver is, let me guess, investment.
You got it. The investment factor is again identified as a primary driver.
Why would cash flow relate so strongly to investment?
Well, it suggests that the information contained in a company's cash flow statement, how much cash it's actually generating from operations, can effectively capture value-related information, perhaps even better than book value in some cases. Especially maybe in situations where intangible assets are significant. Things like brand value or R&D aren't always fully reflected on the balance sheet.
Right. Accounting rules can be tricky there.
But strong operating cash flow might still signal a valuable business, even if the book value is low, and that often correlates with lower investment and thus higher expected returns, according to the Q5 framework.
That makes sense. Okay, finally, let's touch on the work of Penman and Zhu. They developed an expected return strategy by forecasting future returns based on various anomaly variables linked to future earnings growth. How does the Q5 model fare in explaining this?
Right. Penman and Zhu constructed a proxy for expected returns using 8 different anomaly variables known to be connected to future earnings growth.
Okay.
And the paper shows that the Q5 model largely explains the return differences, the spreads, observed when using this strategy.
Which Q5 factors are important here?
It seems both the investment factor and the expected growth factor play significant roles.
Growth makes sense, given the strategy is based on forecasting earnings growth.
Exactly. And the authors of the main paper we're discussing, Hu et al., even argue that their investment CAPM provides a more fundamental explanation here.
More fundamental than Penman and Zhu's approach. How?
Because the investment CAPM directly links expected returns to a company's real investment decisions, whereas approaches like Penman and Zuse rely more on market-based anomaly variables or accounting forecasts. The investment CAPM aims to get closer to the underlying corporate finance decisions.
I see. So across all these diverse quantitative strategies, from fundamental signals to magic formulas to quality and cash flow, the Q5 model seems to offer a pretty consistent economic rationale for why they might be successful,
That's the main thrust, yeah.
often pointing back to these core factors of profitability, ROE, expected growth, and especially investment levels relative to valuation.
Exactly. It provides a unifying framework.
But what about, actual active fund managers, the ones who aren't just strictly following quantitative rules, but using judgment, qualitative insights?
Yeah.
How does the investment CAPM relate to their performance?
Yeah, this is a really insightful part of the papers. They don't just stick to the quantitative strategies. They take a look at the top 20 best performing active discretionary equity funds.
Based on what? How do they pick the top 20?
Based on their information ratios over a long period, that's a common measure of risk-adjusted return relative to a benchmark. So these are funds that consistently added value.
Okay, the cream of the crop. And what did they find?
What they discovered is quite remarkable, actually. The Q5 model explains a substantial portion, somewhere between roughly 59% and 76%, depending on the specific test of their superior performance.
Wow, that much. For active discretionary managers.
Yeah, it's a pretty big chunk. It strongly suggests that even the qualitative insights and maybe proprietary information that these top-tier managers are utilizing in their stock selection are likely aligning, maybe unknowingly, with the fundamental economic factors identified in the investment CAPM.
That's incredible. So even if they're not consciously thinking, okay, I need low investment, high ROE, high expected growth, their successful stock picks seem to be driven by those same underlying economic principles that the Q5 model captures.
That's exactly the implication. The paper notes that these top-performing funds tend to favor stocks that have high expected growth and low levels of investment.
The sweet spot, according to the model.
Right, and they buy them at attractive prices. Interestingly, they point out the average mutual fund portfolio often exhibits the opposite characteristics, maybe chasing growth regardless of investment, or buying low investment firms that aren't very profitable.
So the best managers are naturally finding these Q5 favored stocks.
It hints that they are effectively identifying companies that possess these desirable combinations of growth potential and value, consistent with the investment CAPM's predictions.
And of course, we can't talk about successful long-term investing without mentioning the elephant in the room, Warren Buffett's Berkshire Hathaway. How does the Q5 model shed light on its legendary track record?
Yeah, you have to look at Berkshire. The paper's analysis indicates that a significant part of Berkshire Hathaway's exceptional long-term returns can be attributed to its strong positive exposure or loadings in factor terms on the investment and ROE factors in Q-factor models.
Investment and ROE. That sounds familiar.
It perfectly aligns with the well-documented Buffett-Munger philosophy, right? Investing in highly profitable businesses, high ROE at sensible prices, which often implies avoiding companies investing heavily at high valuations linking to the investment factor.
Buying wonderful companies at fair prices.
Exactly. What's particularly interesting, though, is that the Q5 model still shows a statistically significant positive alpha for Berkshire Hathaway, even after accounting for these powerful factors.
So Q5 explains a lot, but not everything. There's still some Buffett magic left over.
It suggests that, yeah, there might be other unique aspects to Buffett's success, maybe management skill, deal-making, insurance float advantages that aren't fully captured even by the sophisticated five-factor model.
Fascinating. Okay, one potential concern that has come up with some earlier models, particularly those focusing on investment, is how they handle the difference between, say, tangible investments like building new factories.
Right. Property, plant, and equipment.
And intangible investments like spending on research and development or building a brand. They don't always show up neatly on the balance sheet. How does the Q5 model address this?
That's a fair point, and the authors clarify how the Q5 model distinguishes between these. Tangible investment is directly captured by the investment factor, which is typically based on asset growth.
Okay.
Intangible investments, which, as you said, are often expensed immediately in accounting rather than capitalized. Things like R&D, advertising.
Yeah.
These are primarily reflected in the expected growth factor. The idea is that spending on intangibles is often done with the expectation of boosting future growth.
Ah, so they're handled by different factors.
Exactly. Investment factor for tangible, expected growth factor, largely capturing the impact of intangible. This separation helps to alleviate concerns that different accounting treatments for tangible versus intangible might distort the relationship between a company's overall investment activities and its stock returns in the model.
That's clever. Okay, so pulling all this together then, after this really interesting exploration, what are the key takeaways from our deep dive into this research? What should we remember?
I think the main takeaway really is that this investment CAPM offers a really compelling economic foundation for why security analysis can be effective, even in today's markets, which are generally pretty efficient.
It's not just luck or finding fleeting mistakes.
Right. It suggests that by focusing on companies with high quality, defined here in terms of profitability row
Yeah.
and expected future growth, and buying them at attractive prices relative to their investment levels, low Tobin's Q, low investment, investors can systematically position themselves to earn higher expected returns. It provides an economic rationale for value and quality investing.
And the Q5 model is the proof, or the evidence.
The Q5 model provides strong empirical evidence supporting this. It consistently explains a significant portion of the returns from a wide array of established quantitative investment strategies.
Yeah, we saw that.
It explains a lot of the performance of top-tier active fund managers, and even a significant chunk of the returns generated by arguably the greatest investor of all time, Warren Buffett.
The real aha moment for me, I think, is seeing this clear connection drawn between the traditional fundamental Graham and Dodd style of investing
Yeah.
and a modern, theoretically grounded asset pricing model that's rooted in the actual investment decisions that companies make. It feels like it bridges that gap we talked about at the start.
I agree. This is a new, maybe more robust way to think about value and long-term returns. It shifts the focus slightly, perhaps, from just trying to time the market or spot fleeting mispricings
Right.
towards really understanding the underlying economics of the businesses themselves.
Absolutely. This research encourages us, really, to think about those fundamentals. Instead of just looking for, say, a gap between a stock's price and some calculated intrinsic value number, we're getting a deeper understanding of how these core factors be the company's investment choices, its profitability, its growth prospects, how they ultimately drive expected returns, even in a market that's mostly doing its job.
It's about the economics of the firm driving expected returns in equilibrium.
And I'm sure this sparks some important questions for you listening right now. Does this change the way you'll evaluate different investment strategies going forward? How might you start incorporating these insights, thinking about investment profitability growth, into your own analysis?
Yeah, definitely food for thought.
And as we mentioned, the research paper itself goes into much, much greater detail about how they actually construct the Q5 model factors, the various testing methods they used. So there's definitely more to explore if you want to dig deeper into the mechanics.
Absolutely. It's a dense paper, but worth it if you're really interested.
So maybe a final provocative thought to leave everyone with.
Okay.
If these core principles of security analysis, the Graham and Dodd stuff, are inherently linked to these equilibrium expected returns driven by corporate investment, profitability, and growth, does that mean the legendary quest to find the next Warren Buffett is maybe less about spotting those temporary market inefficiencies and more about identifying those truly exceptional companies that are best positioned for sustained, highly profitable growth while also being really disciplined about their investment costs and capital allocation? Is that the real game?
That's a fantastic question to ponder. Is it about finding market errors or finding fundamentally superior businesses whose characteristics naturally lead to higher expected returns? This research certainly pushes us towards the latter. It's definitely a thought-provoking conclusion to consider.